Hi everyone, this is Robert Eldridge again with AnnuityCampus.com. You know, this business has changed so much. I've got to say, some of the changes that's happened in the last 3 or 4 years as far as income benefit riders to the general public has just been outstanding. The reason why is because we all know with annuities, they can provide you an income you cannot outlive. We understand they avoid probate, they're liquid in all different manners. But I got to tell you, until they came out with the income benefit riders, it's really changed the game. And the reason why I say that is because no matter what your cash value is, if you have a variable annuity to go up or down, or if you have an index annuity to go like this, if you have a fixed annuity, it's slow and steady as well. You know, it doesn't matter what the rate or what you get, there's a side value. And that side value is the income benefit rider. So what I'd like to do today is kind of explain some of the basics. And by the way, there's different flavors to these. You know, obviously, I've got all these different companies and brochures. They all work a little bit different, but I want to kind of give you an idea of how these work so you'll be able to make a better decision and see if this is something you want on your annuity, okay? So, first of all, there's on lifetime income benefit riders, there's two phases. There's the growth phase and the withdrawal phase. On the growth phase, on a deferred annuity, is basically just like it sounds. You put your money into an annuity and you let it grow for 3, 5, 10 years or whatever it is, and you might not need the income, doesn't matter. It's the growth phase. You're not paying taxes on money you're not using. So that's pretty easy to understand. The second phase is when all the magic happens, is the withdrawal phase. Now during the withdrawal phase, a couple things happen. They take your age into account and the money that you put into it, alright? And then they give you a roll-up amount every year. Okay, so I'm going to do an example here, but let's say it's 8%. And then you wait 5 years and say, hey, I want to turn on the income. How much will I get every year? Well, let me explain that real quick. So let's say you're 65 years old. You're 65 years old, and you have $100,000 that you want to roll or put into an annuity, okay? Now you're 65, you put $100,000 into these annuities. Most of these annuities will give you a bonus. So let's do that example. So let's say they give you a 10% bonus right out the gate. Okay? So what happens is you put $100,000 in. Your account value is now worth $110,000. Okay? And each year the roll-up amount is 8% roll-up. So what that means to you is you put $100,000 in, it's worth $110,000 with the bonus, and then after 1 year with the 8% roll up, you're looking at a little over $118,000. Okay, and I'm going to show you this. So you put $100,000 in, and let's just draw this out. Let's just say this is year 1. Okay, this is year 1, and you've got about after that you've got let's say $118,000. Okay. And let's say this is a 10-year annuity. However, in the 5th, let's just do a little arrow here, the 5th policy year, you might be wondering, well, what's this account value? Well, I've got a little cheat note here. It's going to be roughly, by the way, this is $, $161,000 and some change. Okay, so at this point, when you go to take the income, and then again, this could be a 10-year annuity all the way down to here, but with $161,000 after year 5, two things can happen. You could say, well, I don't want the income. Yeah, you know what, I do want the income. Well, would you rather take it off of an income amount of $161,000 or an account value that's going to definitely be less than 8% a year? Let's say it's $130. Personally, I'd rather take $160 than less any day of the week. Okay. So you take the income, and what they're going to do, they're going to say, okay, now you're going to be 7 years old. You're 7 years old, and they look at the $161,000, and according to my calculations here, you're going to receive about, let's just say $9,600 a year for life. For life. So would you rather take the income off this amount and let that go for a long time? Yes. Now, some of these annuities allow you to turn off the income on and off, which is a nice feature. But the whole point is here, let me use a different marker here. get $9,000 and some change for the rest of your life. That's pretty nice. And on fixed and index annuities, the cash value will never go down. Okay, so that's how these work. There's a growth phase and the withdrawal phase. They take your age, the amount, they'll add a bonus to it, and then it'll roll up at 8% a year, for example. So after 5 years, we got about $161,000. Now you take income off of that, and at 70 years old, because you're 65 when you started, you know, that's about what, 5% a year? Let me see, make sure here. 6% a year, 5 or 6% a year, and that's how they get this number. And again, there's different flavors, there's different annuities, benefit riders. Like I said, I've got, you know, all these different ones on how they work. But this is the basis of why they were designed, how they work. It's pretty easy. It's not supposed to be complicated. Most of the times there's software for people, and you just plug in your age, the amount, 5 years from now, 7 years from now, and it'll break down year by year how much you'll get for the rest of your life. And by the way, the older you are and the longer you wait to take the income, the higher the percentage. So let's say this was 5%, well, guess what? It might be 7 or 8 if you're older. So if you have any questions about income benefit riders and how they can benefit you on annuities, please do not hesitate to give my office a call or contact me on the website. This is supposed to be a general overview on the concept, okay? And they're all you know, they all differ in little ways, but they're all based upon this model, okay? And if you have any questions, give me a call, and I'd love to help you out. Thank you very much, and have a great day.